Welcome to Capital Conversations. I'm Colin Day. With me today is John Biedenstein.
Hello, everyone.
Thanks for joining me today, John. Today's topic, Roth accounts. All things Roth, let's say. And the reason I want to talk to you specifically about Roth is because of your background in Roth 401k and maybe some of the ideas that are coming about, especially when we look at news and financial topics. One thing that we're hearing quite a bit from our clients is the conversation around Roth conversions. So let's start maybe just by giving a quick brief history of Roth accounts, just so everybody is level set, and then we can kind of talk about some of the things that have complicated Roths, from not just from the IRA perspective, but from 401k, and then maybe we go into a little bit of some opportunities and what we should be looking for in the future. Does that sound good?
Great.
Okay. So when it comes to a Roth account, the origins of Roth, the reason we say Roth account as opposed to post-tax investing is because of Senator Roth from Delaware. So he actually came with this, with another senator, this idea of an after-tax savings account for retirement purposes back in the 80s, but it wasn't actually codified until 1997 that we first got the opportunity to invest in a Roth IRA account. And so for those of you that have been saving in retirement accounts for years, for decades, you might be more familiar with the pre-tax traditional way of investing. I'm going to put money in, I'm going to claim a tax deduction on my contribution. Eventually, I'm going to take that money out, I'm going to pay taxes on it. But when it comes to a Roth account, you're paying your taxes up front, state and federal, FICA. You're paying all that up front. And in this case, the IRS is saying, thanks so much for paying your taxes up front. We will forgive you from paying taxes on the earnings, provided you meet some qualifications. Most standard being you have the account for, what is that, John? 5 years, 59 and a half, right?
Correct.
So Roth accounts are interesting because they offer this great opportunity for investors to put money aside for retirement, first and foremost, allow that money to be invested, and then grow for the future. It's different from pre-tax because many investors probably weren't incentivized to get the tax deduction, especially if they're at the beginning of their careers and they are in a lower tax bracket than where they'll be in the future. I want to pay, I don't know about you, John, I want to pay as little money as possible to Uncle Sam. Legally, of course. I want to always make sure I'm not skirting the law. But I want to make sure that if there's opportunities for me to save one way or the other, that I'm taking advantage of it. And so that's why Roths really came about when pre-tax investing was kind of the realm of all retirement accounts pre-1997. So John, when it comes to like a Roth in a 401k plan, it's a little bit different from the IRAs, is it not?
It's a little different than IRAs in that some of the requirements are actually not applied to 401ks. For example, Roth IRAs, there's an income threshold that if you're above a certain income, you can't make a Roth IRA contribution. That threshold doesn't apply to 401k Roth.
Mm-hmm.
So it's actually, as long as your employer plan allows for Roth contribution, you can do that.
Mm-hmm. Right. And I mean, from a contribution perspective, there's quite a difference between what you can contribute to an IRA or to the 401k, right?
That's correct. Especially if you're over age 50, you can contribute up to $27,000 in an IRA account, in a Roth 401k account. Mm-hmm. But a IRA account contribution, correct me, 7,000?
Yeah, if you're over age 50.
So a Roth IRA contribution over age 50 is limited to $7,000.
Right. So, for many folks, having the ability to contribute to a Roth account in the first place might be stymied by the fact that you or, if applicable, in a joint filing situation, you and your spouse make too much money, so you may not be able to contribute directly to the Roth IRA. But regardless of how much money you can make, you can still contribute to the Roth 401k, right?
That is correct.
And of course, Roth is available outside of, we use 401k as kind of terminology for workplace retirement plan. There are, of course, other kinds of retirement accounts available. Roth 403b plans. If you work in the government sector, there's, of course, Roth 457b. But again, your plan has to offer the ability to contribute Roth in the first place, right?
That is correct. And one thing that's not really passed yet, but the government is really supporting Roth contributions because some of the new legislation that's not proposed or not signed off yet, but that's actually forcing certain contributions to be Roth in the future versus today. So it's the government is a big advocate of collecting those contributions or those taxes now and using them on everything
Everything's in the budget. Yeah. So, and the main reason I wanted to talk about Roth today, again with you, John, is because one of the things that is coming up more and more because of the down market are Roth conversion strategies. So right now, you're maybe reading a little bit more, if you're an avid reader of financial planning blogs, of course, like myself, that there might be a unique opportunity right now to do more Roth conversions based on the fact that the price of the securities in your portfolios are likely at a relative low. And if we use just a brief example, for example, if you've got an account, let's say a Roth IRA, just to keep it simple, you have 100 shares of ABC stock, and ABC company stock is trading for $10. So you have about $1,000 in the account. Well, if you decide to do a Roth conversion, so this is the process where you're taking money that was once pre-tax, like in a traditional IRA, and moving it into a Roth, that $1,000 moving from one account to another becomes a realized event. So you are going to pay taxes in ordinary income tax brackets on that $1,000 as it shifts from one account to the other. But if markets are down, as they are right now, and let's say everything is trading at a premium, so to speak, so let's say it's gone down 20%. So what used to cost you $1,000 to convert maybe only costs you $800 to convert. So we're in a unique situation where, although accounts are down, and we don't wish that upon anybody, of course. We want everybody to do really well in the market. But if the market is at a relative low point, we might see a lucrative opportunity to complete a Roth to take advantage of the fact that we're at a recent low. So within our IRAs, we can work with our clients' tax preparers to make good decisions. So the tax preparer is providing the advice as to what is an appropriate amount as to what to convert in the IRA account world. But we do run into occasionally, John, some individuals that are interested in converting their pre-tax 401k dollars into Roth 401k. What do you think about that?
Actually, making the Roth conversion and doing it within a 401k plan, you really have the same ability to do it within an IRA. I'm not an advocate of providing Roth 401k conversion capabilities within let's start over. I'm not an advocate of allowing Roth conversions within a 401k for one simple reason. It's because that tax burden. Colin's exactly correct that tax burden is lesser today than just because of the market conditions, lesser today than it was maybe 6 months ago or even a year ago. So it would be a lesser tax burden, but you're doing that within a 401k plan. There's always the participant has to remember, I'm going to get a 1099 and have to pay taxes on this in the future. A lot of times people, if you have those funds to pay those taxes outside of the qualified plan, it's great. But if you don't, you're going to have to do a withdrawal from the 401k to pay those taxes again. So it becomes a little bit more of a burden where you end up drawing out more money than you wanted to because of the Roth conversion and the taxable consequences of this. And I know Colin, can go through an example that we worked with someone that ran exactly into that. But you have those same capabilities of doing that within an IRA.
Yeah.
So
and what John was alluding to, I was directed to one of our participant in one of our 401k plans who's interested in doing a Roth conversion, and it was not an insignificant amount of money that this individual was interested in converting. It was in six figures, and so when we talked through the tax ramifications of what that means, adding $100,000 plus onto your income can not only push you up in many tax brackets, but like John was saying, trying to cover that tax liability by doing a tax withholding out of the 401k plan will necessitate taking even more money. So we might not be talking about, say, $100 or $100,000 in the conversion, but maybe to also prepay some of those taxes, taking another $20,000 more for not only federal taxes, but also possibly for Illinois, Missouri, or any other state tax withholding. So there's a major consideration there, and the result of the conversation that I had with this individual is that we didn't convert nearly as much as the first discussion, because after we had the conversation about if it was appropriate or not, it just came about that it wasn't going to be a good idea for this particular individual. And ultimately, it does come down to your financial advisor. It comes down to your tax preparer to help you facilitate, but then also understand the tax ramifications of what you would want to do. So of course, we always suggest talking to somebody before making a decision like that, especially your tax professional.
Yeah, and as these capital conversations play out, I mean, reality is these are very important things to consider in your full financial package, especially when you get closer to retirement. I can put myself in the basket of someone who's been a long tenured participant in a 401k plan, and I have always tended to make those contributions where I get the before tax traditional contribution and I get the tax benefit of making the contribution. But then I let my money roll for years and years and years, and all those company contributions that have been made are also in that taxable bucket. So I know I find myself in others with, I'll just say, long tenured participation in plans. You find yourself with all of your eggs in one basket, which is that taxable bucket.
Yeah.
So doing a conversion could be a great strategy. Also starting to, even if you're been a participant in a long time and you're very comfortable, but transitioning some of those contributions into Roth contributions for future and opening up that Roth bucket so that in retirement you have those funds to pull in, when that, something happens and you have to have an unexpected expenditure. Maybe it's you own a home and it's a new roof you have to replace, or maybe it's something similar to that. But it's easier to pull those funds, just like the example Colin just indicated. It's easier to pull those funds and say, okay, I'm going to take my $8,000 out of my Roth account to fix my roof versus I'm taking 10 grand because I got to pick those $2,000 worth of taxes out too to pay that, pay for my $8 grand new roof. So
yeah, it's and from an opportunities perspective. So this purpose of this particular conversation isn't to dissuade anybody from doing a Roth conversion, contributing Roth or what have you. Each individual has their unique opportunities available to them. But from our standpoint, it is looping in your financial advisor, it is looping in your tax professional before making a decision, not only to perform something like a Roth contribution, but even to have the conversation of, should I be doing Roth contributions in my 401k, my 403b, my 457, my Roth IRA, as opposed to just deciding to do something because their neighbor said the Roth is the better option, or their coworker who's been doing this a little while suggests that one methodology is better than the other. So if you do have questions, I hope you'll reach out to our firm if you do have specific questions about your personal situation, because that's really the best way to get the answers that you need as to whether or not Roth is correct for you or pre-tax is correct for you. But we do hope, what you take from this particular conversation is that Roth definitely is a diversifying instrument, like John was talking about. It is definitely a different way of taking out money in the future that provides you with some flexibility, so that you're not just taking everything out on a pre-tax basis. But there's some choices to be made, and there's trade-offs for it. So, John, anything else you want to add?
Yeah, as Colin indicated, it's one thing to take advantage of the decline in the market in your account balance as of late. To do that, if you wanted to do this, it could cost less now than if you did it, when your 401k is back to a 401k versus a 301k.
On that note, John, thanks for joining me today. We appreciate it. Until the next time,
Thank
take
you.
care.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Correct Capital Wealth Management is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Correct Capital Wealth Management and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Correct Capital Wealth Management unless a client service agreement is in place.